Social Security and income taxation with a pension and 401k RMDs, required minimum distributions. We're going to talk about it here, a real world example from a guy who posted something on my YouTube channel, and I can't wait to go into this. This is fun. This is where the rubber hits the road. Real world problems, but real world tax planning needs to be done here. So I'm excited. So stay tuned, because you're going to learn exactly how the taxes work when it comes to Social Security and pensions and 401k/IRAs, required minimum distributions, and how you absolutely, like my friend here said, get pounded with those RMDs, even if you don't have a lot of income. It's absolutely dastardly. So stay tuned, because you are going to want to watch. So, hey, welcome to Heritage Wealth Planning YouTube channel, my friends, the place you come to learn about taxation, Social Security, pension, 401k, IRA, required minimum distributions, and way you can get that government dastard off your back. I said dastard with a D because it's dastardly how these guys tax people when the least expecting it, and at that point they can't do anything about it. It's dastardly and it's wrong, and I'll show you exactly what I'm talking about. So, don't forget to subscribe, and as always, subscribe if you do. Comments are welcome. Comments help me with YouTube algorithms to say, oh, people like this guy's channel. Let's put it to other people to see. So comment, and of course, thumbs up too. All right, so let's see what we got here. So here I just saw this from my Sather Barry. I'm going to assume his first name's Barry, so we're just going to call him Barry. He says, I'm single. It's depressing looking at a 23% effective tax rate from my chart, turning 62 next year and hoping to retire, feeling blessed to have a small pension, but working at the USPS for over 31 years, I've earned it. Understood. My wife's oldest brother was a long-term letter carrier, and Barry, there's no one worked harder than him, that's for sure. Saved $350,000 in his 401k. Also should receive a pension, about $20,000 a year. Social Security around another $20,000 a year. All right, Barry's doing good here. He's taking half his Social Security and adding it to his pension to try to derive his provisional income, which will tell him how much of his Social Security benefit will be taxed. So he's taking half his Social Security of $10,000 plus $20,000 pension minus a $12,000 standard deduction comes to $18,000, just under my provisional income. And if I don't tap in my 401k, I'm good. But when he starts, he will be pounded. All right, so here's the problem. Big problem. Barry, you don't take the standard deduction when you're calculating your provisional income. Provisional income is only to get an idea how much of your Social Security benefit will be taxed, which will be added to all your other income, which will give you your adjusted gross income, and then you take the standard deduction. So we want to just clarify, standard deduction has nothing to do with the provisional income. Only takes your adjusted gross income, subtract your standard deduction, and then you get your taxable income. So let's talk about what I'm talking about. We're going to show you here. In Barry's case, he has $20,000 of Social Security benefit, and my calculator shows that it'll automatically be $10,000 for when we're calculating our provisional income. He has all other income, $20,000 because he has a pension, $20,000 pension. And so what we do is we take the $20,000 pension plus the $10,000 half his Social Security benefit, and gives them a provisional income of $30,000. All right. So $30,000, what that simply means is we take, we basically take $30,000, subtract by $25,000, and that gives us a second bend of your Social Security provisional income. The first $25,000 if you're single is tax-free. The next amount for provisional income is taxed at 50%, or 50% of that benefit will be subject to taxation. So again, $30,000 is provisional income. We got that from half his Social Security benefit, and all the other income he has, $30,000. Say we subtract $25,000 from that $30,000, and we divide that by 2. It gives us $2,500. Or you just do the calculator. I have this calculator available on my website, and I'll post a link in the show notes. So that gives us an adjusted gross income of $22,500. All right, $22,500. Again, we take all of our other income plus our provisional income, $2,500. That gives us our adjusted gross of $22,500. Take our standard deduction off, and now we have taxable income of $10,500. Don't pay attention to this yet. I'll come back and show you what I'm talking about. So $10,500 is our taxable income. We go back to this other little cheat sheet here, $10,500, and we hit enter. And he has a tax. Now, he is in a 12% tax bracket, but his tax is only $1,070, and he just went over the 12% tax bracket because his 10% tax bracket stops at $9,500, and the next bracket is 12, which stops at $38,700 of taxable income. All right, so he has $1,070 of tax due, and we just dump that in here to get our effective tax rate, and his effective tax rate is 2.68%. So let me write that down. So he pays tax of $1,070. $1,070 on $40,000 of gross income. So that's not so shabby. That's not so shabby at all. All right, but he also has a 401k. All right, so he has $350,000 in his 401k. He's just turned 62, so we're going to say he gets 7% a year on his 401k, just for simplicity. So we use our trusty little calculator. 350 is the present value. 0 is the payment. 7% is going to be our interest. We're going to do it for 8 years, between 62 and 70. So in 8 short years, he'll have $600,000 in his 401k, which means he'll have required distributions of, well, we got to factor in what the IRA tables for required distributions are. And 70 years old is 27.4. So we take 601,000, we'll just say 601,000 divided by 27.4, and he'll have to take out $22,000 from his 401k. So now at 70, everything's going to change, right? So remember, effective tax rate 2.68, our tax is $1,000. But now we're going to add another $22,000 to this, which would make that his $20,000 pension. I'm presuming there's no COLA, plus another $22,000 of IRA 401k distribution. So this would be $42,000. And let's see how things change. Now, what happens is his Social Security benefit is only $20,000, but the IRA distributions made his provisional income $52,000, which means that this will give us a calculation of $19,800 will be subject to taxation, but it's not. It's the most will be subject to taxation will be this number or 85% of that number, whichever is less. So in this case, it's $17,000. So of his Social Security, $17,000 will be subject to taxation, and we take the other income he has, his pension and his required distributions, which is right here, and we put that there. So we have his Social Security provisional income, how much of his Social Security is subject to taxation, plus his other income, and that gives us this plus this, which gives us a total of $59,000 for his AGI. So now we're going to come over here at $59,000, take that in, and his taxable income is $47,000. All right, $47,000. So we go back to our calculator here, $47,000. Put that in for the taxable income area, and now his taxes are $6,268. All right, $6,278 on how much did he have his total income? $62,000. So he has $20,000 in Social Security, $42,000 as his other income, which consists of his pension and his 401k distributions, and he has $6,278 is his tax, 6,278, and his rate went from 1% roughly effective tax rate to 10%. All right, so here's what hammers you. This actually drives me up the wall. His income went from his gross income from $40,000 to $62,000. So his gross income increased by $22,000. So we take $22,000, divide that by 40, because that's what we started with. And his gross income, 22,000 divided by, 40, right? 40. His gross income increased by 55%. 22,000 divided by 40. Yeah. All right. So because he has 62,000, 22,000 divided by 40, that's what he had before. All right. So his gross income increased by 55%, but his taxes increased by 5,000. We have 5,000. We have 6,278 now. Subtract 1,070. His taxes increased by 5,208, which is 486% more than what it was before. So his income increases by roughly half, but his taxes go up by almost 500%. And the reason for this is simple, is because in the dastardly tax code we're living on, lower earners with Social Security pensions and 401k distributions, not only do they have to pay tax on that distribution, but now it makes more of their Social Security subject to tax. It's a complete double taxation if there was one. Remember, before he only had $2,500 of a Social Security subject to taxation. Now he's got $17,000 subject to taxation. He hasn't earned any more money. I mean, he still has the $22,000 more of a required distribution, but Social Security hasn't paid him anymore. It's just more of it, a huge more amount is subject to taxation. It's crazy. It's crazy, crazy because of the required distributions. But on top of that, watch this. This is going to make you mad too. It's not just that. So he has to pay higher income tax because he's now in the 22% tax bracket because the adjusted gross income above $38,000, you're now in the 22% tax bracket. His adjusted gross income is $47,000. So he has to pay higher income tax rate, has to pay a heck of a lot more in Social Security taxes. But now he's in the 22% tax bracket. Guess what? If he has any qualified dividends or any long-term capital gains, those things were before not subject to any taxes. Nothing. Now they're subject to 15% tax. So it's a triple whammy. Not only does he have higher income tax rates, higher income tax on Social Security, but now he gets whammed again because his qualified dividends and long-term capital gains are subject to tax. Now, if all he has is his 401k for investments, it doesn't matter because that's all coming out of his ordinary income. But this is a real-world example of how the tax code hammers you. Now, let's just say this. Let's fast forward until Barry's 85 years old. We'll say he's 85 years old. He's got a 14.8 divisor on his 401k. And now we're going to say his 401k dropped from $600,000 to, we'll say, $450,000 because he had to take distributions. So we take $450,000 divided by 14.8, and now he's got $30,000 of mandatory distributions. All right, so he's got $30,000 of mandatory distributions plus his $20,000 in pension. And again, I'm assuming there's no cost of living. If there's a cost of living, it's only going to get more brutal. So now he's got $50,000 here. It's actually close to 51, so I'm going to say 51. 51,000. Watches what happens. Again, his Social Security will still be 85% tax. And again, we're not even giving this a cost of living adjustment either. But just bear with me here just a second. So he's got 61,000 provisional income. We know for a fact that his Social Security will be subject to taxation. 17,000. So now we take 17,000 plus 51,000. And he is sitting at $68,000. So he's right there at the threshold where his Medicare premiums start getting taxed more. Let's say it'll still be in the 100. Part B will still be $138, and Part D will still be 134. Part D will still be 34. But let's just say though he took a lump sum distribution to, I don't know, he's got a child and puts her in a wedding. So we'll say he took $50,000 out of his IRA. You with me? So $50,000 on his IRA combined with the $20,000 pension he's got. Now he's got $80,000 provisional income. We just know again $17,000 of his Social Security be subject to taxation. We take this equals that, and we get $87,000 of income. And guess what, my friends? His Medicare premiums now go up. Was it to 188, 198 or so? It goes up like 40% now too. That ticks me off. It just does. It's a four-bagger against you. Oh, we care for the little people. We care for the little people, says those guys in D.C. and ladies. If they care for the little people, my friends, they would get this fixed ASAP. But they don't, and they won't because people are ignorant about it. It's just no getting around it. People are ignorant how the tax code works and how it hammers lower and middle income people. And if it doesn't bother you, it should. Because it will happen to you too. I'm just telling you right now. You might not be looking at higher Medicare premiums. You might not be, but you're going to be looking at higher Social Security taxation, guaranteed. You're going to be looking at higher income tax brackets, guaranteed. You're going to be looking at higher taxes as well, as we can see by Barry. 55% increase in gross income leads to a 500% increase in taxes. It's actually 486%. So pardon my not rounding. I'm rounding to the highest number. Okay, we'll say 450,000%. I frankly don't care. It's just wrong at every stretch. On top of that, his Medicare premiums. On top of that, his qualified dividends, long-term capital gain. It's sickening. So Barry, my friend, this is what you got to contend with. And now what you say here, and I'm just going to tell you, don't wait until you're 70 to start pulling money out of your IRA. because we've already established. Let's just go back here now. Let's say you start pulling your IRAs, your 401k. I'm going to move myself down so you can see my mug. Let's just say you start taking an extra $15,000 a year off this account. All right, so $15,000 plus your pension. So now we got $35,000 of all other income. So now our provisional income is $45,000, which puts us at $13,850. All right, cool. So now if you take $15,000 off your IRA, you'll have to pay taxes, or at least I will say $13,850 of your Social Security will be subject to taxation, $850. All right, plus this amount right here, $48,850. All right, so we're going to take this, take that there, $48,850, $36,850 is now your taxable income. You go over here, $36,850, and you are still, my friend, in the 12% tax bracket, $36,850, and your tax is now $4,200. So you're going to pay a little bit more tax today to avoid a wallop in the future. And the fact that you're still in the 12% tax bracket means you don't pay taxes on capital gains and dividends. You don't pay a higher income tax. You don't pay hardly much more in Social Security. You need to start pulling money out of this puppy ASAP. And again, wait till you retire. I don't want you doing it while you're still working, but maybe pull $10,000, $15,000 a year out, whatever you feel comfortable with. But don't wait till you're 70, because when you wait till you're 70, the taxes is going to hit you hard, and it's only going to get worse, because once you hit 70 and 71, 75, the amount of distributions you have to take out become larger and larger and larger. Just as bad. Anyway, man, I appreciate you giving us this to chomp on. I hope other people can learn from this. Man, share this video with your friends down at the post office. Share this video with folks you know, and whatever folks, not just Barry, but if you're watching this, show them how this video will show them they're going to get hammered in taxes if they just sit there and allow their 401k to keep accumulating until they're 70 years old. I'm telling you, it's evil. I don't know how else you could put it, but I mean, it is what it is. I mean, you can gripe about it all day long. It's not going to change the facts that you will pay more tax. You'll pay a higher tax bracket. You're going to pay more in Social Security taxation. You're going to pay tax on qualified dividends, capital gains. And on top of that, you may pay a significant increase in Medicare premiums too. So as always, if you like what you see here, subscribe down below. I will put the link to this in my in the show notes here. And then, like I said, comments, thumbs up, always helpful. And so don't forget to do that. And then go to heritagewealthplanning.com. That's the blog. Well, I guess I'm going to put the link anyway. So we'll see you next time. Thanks, guys.